Okay, I think you're seeing chapter 1, part 1 was under the chapter 1 module. I'll put part 2 from tonight under chapter 1 as well. Okay, and so here we go with the fun part, guys, which is when I put my tablet into tablet mode, for some reason, I get some pushback from the computer. So let's just see what happens. Okay. Nothing so far. So let's go ahead and keep our fingers crossed. And we finished up with module 4 last time. So we are going to begin on module 5. Put my machine in full screen. And let's go ahead and take a look at financial risk management. Okay. Now, when we look at this, for the most part, we're talking about the entity that is going to be issuing some sort of financial instrument and how the different risks will affect that entity. And so we really start out with definitions, and then we're going to go ahead and use some of these definitions for some calculations that we'll see coming up. So we're finally going to start getting into some calculation. So they talk about trade-off between risk and return. And really what we look at generally is if we see increased risk, we would expect an increased return. In exchange for less risk, we might be willing to accept less return. Okay, so risk is the risk that there will be a financial loss. So what will we do? We'll invest in some sort of security, some sort of bond or something, and the risk is that we will suffer financial loss. The return is what we expect to get off of that particular investment. So there'll either be a gain or a loss will be the return. Now, we talk about risk preferences, okay? And we're going to go ahead and take a look at these, but let's just start with the most common case, which is really what we just set up above, which is risk adverse behavior. And it reflects an attitude towards risk in which an increase in the level of risk results in an increase of management's required rate of return. And they tell us most managers are going to be risk adverse. And I think that's the case. I mean, that's just almost human nature, that if I'm going to take on more risk, I expect a better return. Now, they talk about risk indifferent behavior, and this is a risk in which we do not necessarily look for a higher rate of return in exchange for increased risk. But I would start to wonder what's going on with management that they don't expect that sort of return. But they do say that that is a risk preference. Risk-seeking behavior looks for more risk with lower return. And I'm almost think of that movie Jackass, I guess, is the only people I can think of that may be engaged in that kind of behavior, more risk with less return, okay? But even then, they're looking for the return and whatever they're charging people to go watch that movie. So why don't you go ahead and flashcard, okay, the different risk preferences. But note that for the most part, we're going to be this risk adverse behavior. Okay. And I'm going to just go ahead and hit mute because I've got some ambient noise coming in. So I'm going to take care of that right here. Okay. All right. Good. Let's go ahead and just mute, folks. Okay. All right. And of course, if you want to speak, of course, unmute. But sometimes there's some background noise coming in, so that's why I put everybody on mute. But if you want to say something, by all means, or if I ask you a question, by all means, unmute yourself. You have the power to do that. Okay. Let me do one more thing here, though. I do tend to turn off the chat. Okay. All right, good. So let's go ahead and take a look. And again, very definitional here at first, guys. And so you're going to see that I'm going to be asking you for flashcard as we go through and get into these various types of risk. Okay. Risk exposure includes interest rate, market, default, credit, liquidity, and price risk. So let's just look at all of these, okay? So let's start with interest risk, and it represents the exposure of an owner of an instrument to fluctuations in the value of the instrument in response to changes in interest rate. Go ahead and flashcard that so that you realize that that is a type of risk and what the definition is. And Becker does a pretty good job with these as we go along, giving us some examples. And I think I'll go through most of the examples. There's a couple of them where the definition is self-explanatory that we don't need to look at the example, but let's look right here. And we have this Thermodynamics Inc. owns a 5-year 10,000 Duffy International coupon bond purchased at a discount. Recently, the market rate of interest increased 1%, causing the market value of the bond to decline to 9,610. And it makes sense that you have a bond paying, say, 5% interest rate, and then interest rates go up to 6%. That bond is going to decrease in value. So assuming the bond's carrying value was this 9,840, they told us that it did issue at a discount. The increase in interest rate would cause a market loss of 230. The 230 obviously being the difference between the 9,840 and the 9,610 is going to give us that 230 difference, because the market value of that bond has decreased because of the shift in the interest rates upward. Okay, good. Let's take a look at market risk, and it is also called systematic or non-diversifiable risk. And market risk is sometimes referred as non-diversifiable, easy for me to say, non-diversifiable risk, because it is the risk that inherent in operating within the economy. Okay, non-diversifiable risk is attributable to factors such as war, inflation, international it's going to be one of those nights, incidents, and political events. Okay, so just flashcard that. We don't need to look at the examples here. I think you can see that these are risks that affect the entire market, and you cannot diversify your way out of those risks. Now, unsystematic risk, also referred to as diversifiable risk or firm-specific risk, and you can see that it is diversifiable is attributed to firm-specific or industry-specific events such as strikes, lawsuits, regulatory actions, or loss of a key account. The idea here being that you can diversify this risk by investing in a stock or whatever that moves in one direction when, I don't know, when the classic example right now is you might go ahead and invest in pharmaceuticals now when, we're suffering through the pandemic, and you're not going to invest in travel stock. Then later on, as travel opens up, maybe you take some of your money out of pharmaceutical and put some of your investments in travel stock, because those move in different directions, right? As we start to have, better health situation, we can go ahead and expect there'll be more travel. Okay, so you can go ahead and flashcard that. Let's take a look at credit risk. And with credit risk, you can think of maybe your own situation. Maybe you're going to be going for a loan for a home or a car or something like that. And if your credit is good, you can expect a little lower interest rate. If your credit is not so good, then what? Then you're going to sit there and you're not going to see as good of an interest rate. So as credit ratings decline, interest rate demanded by lenders increase, collateral may be required, and other terms generally less favorable to the borrower. That's considered credit risk, and you can go ahead and flashcard that definition. Okay, and again, I'm not going to necessarily go through examples where the thing to me seems very clear as to what we're talking about. Default risk affect lenders. Creditors are exposed to default risk to the extent that it is possible that its debtors may not repay the principal or interest. We consider that default risk. You can flashcard that. Again, I'm not going to go through examples when it's pretty obvious what we're talking about. Okay, let's take a look at liquidity risk. And liquidity risk is going to be the risk that we're not going to be able to sell off a particular investment in an orderly market. It's going to be almost some sort of fire sale where we're having to dump a particular security quickly. So liquidity risk affects lenders. Lenders or investors are exposed to liquidity risk when they desire to sell their security, but cannot do so in a timely manner, or when material price concessions have to be made to do so. And you can go ahead and flashcard that, but I think that one's worth the example here. We've got this Smithfield holds several fixed income securities of Johnson Manufacturing. And due to the current operation needs, Smithfield attempts to sell $250,000 Johnson's 10-year bond, but is unsuccessful in attracting willing buyers at current market prices. And so if that's the case, Smithfield may have to significantly discount the bonds to obtain the proceeds for the investment. I would almost think there the example, if you all of a sudden have a crash in the real estate market and then you're sitting there saying, well, I need to sell my house, you're going to probably suffer some liquidity risk because it's going to be very difficult for you to sell off, that particular investment, your home, if the market is all of a sudden crashing or something. And a lot of people suffered through that during the 2008 real estate decline. Price risk. And price risk represents the exposure that investors have to decline in the market value of individual securities or portfolio. Factors unique to individual investments or portfolios contribute to price risk, which becomes even greater concern when there is an increased market volatility. Price risk is diversifiable. Okay, again, as one sector of the economy improves, another sector may not do as well and vice versa. So you go ahead and you kind of diversify away that price risk, and you can flashcard that. Okay. All right, good. So we have some definitions, and we're going to continue with definitions, but we're also going to see some computations here. So first off is stated interest rate, and the stated interest rate is the easiest one, in that it is basically what is stated in the terms of the agreement. Whatever the interest is that's being charged or paid on that, it's stated in the terms of the agreement. And so there's really no computation because it's stated, it's written on the documentation of the loan or whatever it is, what the interest rate is going to be. So you take a look and they say, well, 10,000 promissory note states that payments will be made quarterly at 10%. And the question is, what's the stated rate? Well, the stated rate is 10% because that's what it said. Effective interest rate is going to involve some computation. So let's go ahead and take a look at that. And for the effective interest rate now, interest rate represents the actual finance charge associated with borrowing after deducting loan proceeds for charges and fees related to loan origination. So often there's going to be some sort of fees that are charged, recording fees, these sort of things up front. You're going to have to back that off of the proceeds to calculate what the effective interest is. And so after you've made that calculation, effective interests are computed by dividing the amount of interest paid based on the loan agreement by the net proceeds that are received. And so you can go ahead and flashcard that computation. Let's go ahead. Yeah, let's take a look. I think it is helpful. Remember, guys, in our How to Study guide, I don't generally tell you to read the book, although we are highlighting flashcarding quite a bit in this chapter. We probably won't need to do as much of that going forward, but in some of the later chapters. But notice here, the good way to go through this is to flashcard what I've asked you to, study the examples, because that confirms your understanding once you look at the example and you understand the example. So here now we have a $10,000 promissory note at a stated interest rate of 10% per annum and is due in 1 year. Bank charges a loan origination fee of $75, and the state in which the loan is made levies a $50 documentary stamp charge. Taxes and fees are taken from the loan proceeds to calculate the effective rate. So we have what? Interest paid is $1,000, and then we're going to divide that by, and notice we have to go ahead and subtract out those fees and whatnot to get the net proceeds, and then that gives us the effective interest, because we didn't get the full 10,000, so it's not just the straight 10% because we got less than the 10,000. Come over and let's take a look at annual percentage rate. And the annual percentage rate is something that is required to be disclosed between lenders and borrowers by federal regulation. So why don't you just go ahead and flashcard that. The federal government comes in and says you have to disclose the annual percentage rate. And all we do here is we go ahead and we take a look at the effective rate, but then we annualize it. So even if the loan is for less than a year, we'll have to go ahead and turn that into an annualized rate. So let's just look at the example. And again, we have a $10,000 promissory note, displays an interest rate of 8% with interest to be paid. And because it's paid semi-annually, we're going to have to turn that into an annual percentage rate under federal requirements. So the state charges a $75 loan origination fee, and there's that $50 fee by the state. So again, the interest paid is going to be in the numerator, and then we're going to divide that again by the net proceeds after considering those fees. That gives me the rate, but that is for what? Since we went ahead and noticed we did this for 6/12, that gives me for the semi-annual compounding, but then I need to go ahead and multiply that number by 2 to turn it into an annual percentage rate as defined by federal statute. Okay, good. Now we also have something called the effective annual percentage rate, and that is abbreviated APR. Now, when we look at this, we can see for the number of compounding periods per year, the effective annual percentage rate, we abbreviate that, as I've said, APR. And what I want you to do is flashcard this formula and flashcard what the different items in the formula stand for. Okay, so you're going to have to know these kind of formulas so you can go ahead and calculate that if you get asked effective interest rate. So you can see here from the facts, 8% stated interest rate, compounded semi-annually 2 times a year. And when you look at the solution, you're going to use the formula. You put that information in there, 2 periods. That gives me the effective rate, and we always take that -1, and then that's going to give me the effective interest rate here of 8.16. Now, for this one, I think it's worthwhile to put in here just so you can kind of see the connection to the present value tables or future value tables in this case. Put here also see future value of dollar table. Okay, and so when we take a look at this one, and I hope I didn't close that. If I did, I'll have to look for it again. Let's see if I can find it again, guys. Yeah, I'm gonna have to. It's gonna get dicey because I don't trust my computer. Is it worth it? I want to say it's worth it. The other part of me says no. Okay, I'm going to try to do it. Okay, let's do it this way, guys. Let's see. Okay, and this looks like future value of the dollar. Okay, and hopefully you can see that on your screen. You may have to make your screen a little bigger, but what we would do here is we would go ahead and we could follow the information in that particular calculation. And so we're looking and we have an 8% state of interest compounded semi-annually 2 times per year. So if you were to go to the second row here and you run your finger across to the 4% semi-annual rate, notice you get that same number that comes into the parentheses, that 1.08160, and then of course you would subtract 1 from that, and that would also give you this answer to the effective annual percentage rate as well. So on the exam, they have a section there in your software that says tools. And so if you're trying to avoid having to do a calculation where you're having to the second power, although if it's the second power, generally what I'll do is I'll just multiply the same number by itself twice to just give me that number 2 rather than have to use the exponential factors on the calculation. But you could also look at this table here, and sometimes they have the tables, sometimes they don't. So that's why I want you to memorize the formula, but sometimes you could also maybe double check your calculation, or if you're having trouble with the calculation, maybe look to the table to help you. Okay. Okay, good. Let's try to put it back now. Okay. All right, and let's go ahead and go back to the textbook. Okay, good. Now, simple interest, and I think the key word here is simple, okay? For simple interest is the amount represented by interest paid only on the original amount of principal without regard to compounding. Simple interest formula is as follows. So let's just go ahead, and I think the formula here is probably the most useful thing to flashcard as opposed to sitting here and worrying about the definition. And a $10,000, let's look at the example, 8% for 2 years. And what is the simple interest? And so you simply do what? The word simple there, you take the 10,000 times 8%, 2 years, that's what? That's $800 per year, or $1,600. That's simple interest. Most of the time, the only time you're going to be calculating simple interest is on an exam or in some sort of, the CPA exam or in a class or something like that. It's an academic thing. Very rarely is simple interest used to make any kind of business decisions because it's just not very meaningful. Okay, completely ignores time value of money, which is ridiculous if we're talking about business transactions. Compound interest, okay, and let's just go ahead and take a look at the elements in here. And then what I want you to do, because they don't ever really give us the formula up there, they give it to us here. So flashcard that formula, but let's just go ahead and take a look. And we have a promissory note for 10,000, carries an interest rate of 8% for 2 years, compounded annually. So now what happens is you do what? you take the interest that was earned for that period, add that to the principal, and the next period's interest then is computed on the increased amount because you added on the interest from the first period, and so on. And so you can see here that they take this 10,000, the interest rate is what? Is 1.08, and if we're going to multiply that by itself, that would be to the second power. And so we go ahead and they do the work inside the parentheses, and that gives us 11,664. You could also do what? You could take the 10,000 and take the period 1 interest, add it to the to the original principal amount, and then you would go ahead and whatever the period 1 plus the 10,000 in this case, or we could just call that principal to make it more general, so it doesn't have to be specific. It's not always going to be 10,000. Principal, right, times plus period 1 interest, right, times the interest rate for the second period. So times the interest rate again for the second period would also give you the answers to what the interest was on that. Now, what you could also do is look at that table again. Really? Is it here? Yeah. Okay, and let's just look again at the future value of the dollar table. And when we look at those factors, you look for what it is 2 years at 8%. So you come over to the 2-year column, you come over to the 8%, and notice you get that same factor right there, that 1.16640. So you could also get that off of the table, and that would tell you what that had grown to over 2 periods at 8% interest, looking at future value of a dollar. Okay, again, that assumes you have the table available, but I do want you to go ahead and flashcard the formula for that, and I gave that to you in the example. You know, I pointed that out to you in the example so that you can go ahead and calculate that if you need to what would it grow to, the value, maturity value, the promissory note over 2 periods. Okay, question? All right, good. Let's go ahead then.
I have a question. So during the CPA exam, do they provide the table for us?
They may or may not. That's why I'm asking you to flashcard the formula, but I'm just pointing out to you the connection between the formula and the table, so that if the table is there, you can use the table. Okay. So they may or may not give you the full table. I don't know. It really depends. There's a tools section, and sometimes you'll see the present value factor. Sometimes what they do in problems is they'll give you a variety of factors to choose from. And so you would have to know how to use the table to pick up the correct factor. So that's why I'm pointing you back to the table. So even though they won't give you the whole table, part of the problem may give you a chunk of the table, or give you different elements of a table that you have to, different elements from a table, and you have to pick the right one.
Thank you.
So that's why I'm kind of trying to connect up these calculations to the tables. Okay. All right, good. Let's take a look at the required rates of return. And required rates of return is calculated adding the following risk premiums. Okay, so basically what we have is the risk-free rate of return, and then we can add a premium for these different factors that we're going to go ahead and define. Now, the risk-free rate of return is basically whatever the rate is for federal bills, notes, bonds. Okay, the idea being that the federal government should not default on its debt. Now, that's why, to me, it's always annoying that when they come up to the debt ceiling, they have to raise the debt ceiling. And why they ever invented the debt ceiling is ridiculous. I mean, it's something that was created by Congress that does nothing but throw Congress and the in the country into turmoil every time the debt ceiling comes up and they have to raise it. I mean, it's an artificial thing that they created. And then they sit there and they go through this dangerous exercise where they say, well, we're not going to raise the debt ceiling. Well, the problem is that the federal government passes a budget that requires enough deficit spending that makes it necessary. It's a mathematical certainty that they will go over the debt ceiling. So they pass a budget that's going to require enough deficit spending, so they'll go over the debt ceiling. And then when they start to come up to the debt ceiling, they play this game where they do this silly little game of chicken that they're not going to increase the debt ceiling. But if they don't increase the debt ceiling, they won't be able to pay the debt that's maturing. And if they don't pay the debt that's maturing, then the federal government would default on its debt and there would be no risk-free rate of return. And that sound you hear is financial markets collapsing. So when you hear all that discussion about, oh, the debt ceiling, and we're not going to raise it, and just know that they're gaming you. They want to keep you in a mode of fear all the time. Okay, because they know that fear motivates you to take certain actions that they want you to take and certain things that they want you to vote for. Okay, so that's it for my speech about the psychology of politics a little bit here, particularly with the debt ceiling is one that just irritates the hell out of me because I get friends and associates, people that I meet. The electrician who came to do work at my house one time says, well, let's just default on the debt. That's okay. And I'm like, why don't you stick your finger in that light socket and see what happens? That's about as bad as what you're talking about right now. So I feel like it's people being taken over by the body snatchers when they start talking about that like that way. But anyway, all right, stop, John. Okay, so let's just take a look. And we have a maturity risk premium. And it is the compensation investors demand for exposure to interest rate over time. The risk increases with the term to maturity. That's why we should flashcard that you're going to add to the risk-free rated term, which is usually federal bills, notes, and bonds interest rate. And then you would add a maturity risk premium. That's why when you're looking and you have a 15-year mortgage versus a 30-year mortgage, the rates tend to be lower on a 15-year mortgage than a 30-year mortgage because they have to wait longer. And so there's more chance that stuff will happen during the term of that loan. Okay. Coming over and taking a look at purchasing power risk or inflation premium is the compensation investors require to bear risk that price levels will change and asset values or purchasing power of invested dollars. And they give us the example of real estate. So as prices of real estate go up, we would expect that there would be some purchasing power risk, although I think it's kind of have moved in the opposite direction over the last year or so, but a lot of folks will argue that that's artificial because during the pandemic, the government has really wanted to keep the interest rates down. So some folks are saying, well, look, we're going to see an increase in interest rates, and then that's going to drive the price of real estate down over time. But that purchasing power risk really relates to inflation. Liquidity risk premium is the additional compensation demanded by lenders for risk that an investment cannot be sold on short notice without making significant price concessions. And that is also, liquidity risk is defined as the ability to quickly convert an asset to cash at fair market value. And they give the example of junk bonds. You don't see too much investment in junk bonds anymore. That sort of was an 80s thing, probably before you guys were born. But the situation there is, hey, what if there's a sudden drop in the value of these things? I won't be able to sell them. And so they would have a liquidity risk there. Default risk premium is additional compensation demanded by lenders for bearing risk that issuer the security will fail to pay interest and/or principal due on a timely basis. And that really relates to a large extent on their credit worthiness. But again, if they don't have as good a credit rating, we would expect an additional premium for default risk. Now, I think that it's worth knowing here that what the definitions are, but you simply take that risk-free rate of return, and then if you have a problem that tells you, they don't have to tell you all of these, okay, maybe some of these, it may be a couple of them, then you go ahead and add that on. I'm putting plus signs there because you will add that on to the risk-free rate of return for these different premiums. And that's what happens in this example, guys, and I'm not going to get into this is worth noting here that you have the nominal rate of return and nominal rate of return, okay? And I don't know if the definition said that or called it the nominal rate of return, but if not, I didn't see it up there, and I don't care if it was up there for inflation. Yeah, they probably should have defined that up there. So let's just do it right here. That the nominal rate of return, okay, we can put a flashcard right here in the example, is the real rate of return plus the inflation premium. And then you go ahead and you start adding in some of these risk premium factors that we've been talking about, and that would give you the required rate of return. So again, risk-free rate, add the inflation premium, that gives you the nominal rate, and then for those different risk premiums that we talked about, and we flashcarded up there, then you would add them. And again, it doesn't have to be all of these. For example, in this case, they only gave us a default risk to deal with, and so that gave us the required rate of return. So again, I would define that really as how you calculate the required rate of return. Okay. All right, good. So let's now look at some tools that will mitigate or control. Mitigate means take away some of these financial risk. Okay, so let's just look at some strategies here to mitigate that. And one is diversification. Okay, so with diversification is a process of building a portfolio of investments of different and offsetting risk. And notice that they tell us, in theory, an investor can create a portfolio of assets that eliminates all or virtually all diversifiable risk. They always say that, I sometimes question that because it almost involves like, well, you'd have to have a crystal ball that would actually sit there and figure out how one thing moves versus the other. And I guess there's historical data out there. So I think when they say all, I think they really mean virtually all. There'll always probably be some amount of risk that you can diversify out of, even though it may seem diversifiable, but that's just my own personal. But from a flashcard standpoint, yeah, go ahead and put that down as something about diversifiable. Okay, now strategies to mitigate and control specific risk. And so let's take a look. We talked about interest rate risk. Okay, an investor can mitigate interest rate risk by investing in floating rate debt securities, which do not change in value. In floating rate securities, which do not change in value when interest rates change, and also generate higher coupon payments when interest rates rise. Derivatives such as forward rate agreements or interest rate swaps, in which the investor pays a fixed interest rate and receives a floating interest rate, can also be used to mitigate interest rate risk. So let's just go ahead and flashcard that last part. Okay, and let's just look at this example. And so you can see that we have the example of interest rate swap. And let's just see how East and West Company does this. And the only thing that bothers me is when they do the example down here, and this is a pretty good example, but why didn't they put the West Company on the left side and East Company on the right side? But that's okay. We'll go ahead and forgive them for their poor geographic example here. But let's just take a look. So East Company has invested in $1 million, 8% fixed bonds. East expects interest rates to increase during the next 12 months. On January 1st, East Company enters into an interest rate swap with West Company, in which East Company agrees to make to West Company a series of future payments equal to fixed interest rate of 8% on the principal amount of $1 million. In exchange, West Company agrees to make to East Company a series of future payments equal to floating interest rate of SOFR +1. Okay, and this SOFR is this particular index that they're using for this. Okay, so we look and we have the notional amount of $1 million, and then we have the settlement amount, and it's 8%, 80,000, and for West Company, it's this SOFR +1. And on the first settlement date, SOFR was 8.5%, so we have to add 1 to that. So that means that West Company has to pay to East Company, what, 95,000, and of course, East will give West the fixed amount of 80,000, and so East Company protected itself by entering into this interest rate swap. Now, it's interesting to me here in that they look at this and it's like, well, who's right? You know, I guess in this first example, East Company was right, but what would happen if the SOFR +1 was lower than the 8%? Then it would have turned out that West Company would have been right. So it's really, you know, almost would want to call it gambling, you know, because two different companies with two different views of how things are going to turn out. But of course, you know, there would probably be some more analysis than just, you know, just flipping a coin on this. But it's really gambling. It's like betting on a football game because nobody knows exactly how these things are going to turn out.
So why would anyone do that? To try to hedge bets? Because
they think, you know, East Company thinks that the interest rates are going to increase, but obviously West Company thought interest rates were going to go down. And so two different companies, two different ideas of where interest rates are going.
Okay.
Yeah. I don't know why they're doing it. Somebody got screwed here. I guess it was West Company miscalculated, you know. Yeah.
It seems like a kind of a shady thing to do if you know it's gonna go, if you think it's gonna go up, then you're trying to get rid of it. It just doesn't make sense why anyone would buy into it then.
Two different points of view, you know, winners and losers. I mean, this is definitely a zero-sum game here. Okay, East Company's gain was West Company's loss because they got 80,000, they had to pay 95. Okay, good. Taking a look at how we might mitigate market risk now, and market risk cannot be mitigated through diversification. One way to control market risk is to invest in derivatives that provide gains to the investor when the market declines. Short selling is of hopes of buying back at lower prices is another strategy that provides returns when markets decline. Okay, now there was a lot about short selling, you know, that you probably saw in the, you know, financial press and whatnot with the GameStop. What is it? Stock. And basically what happens is I basically borrow a security from, say, a broker, and the securities say trading at $100. I sell the security for the $100. Now I have $100 in my pocket. Now what I'm betting on in a short sale is that the price is going to come down. And so I'm hoping that I'll be able to basically buy that stock when I have to give it back to you for, say, $70, and I have to give you 70, but I get to keep the extra 30. Okay, that's a short sale, and that was betting on the fact that the market would decline and the stock would go down. The way the what is it called, GameStop situation was working is these, kind of like punks, what they were doing is they were sitting there and they were buying up stocks that that the institutional investors were predicting were going to go down. They were buying them up, driving the price of the stock up, so that now institutional investors basically got stuck having to buy the stock for a higher price. So they were actually losing money on those transactions. And, everybody kind of laughed about, oh, haha, look we stuck it to the big guys. But, it wasn't really funny because, these institutional investors are often pension funds, school districts, these kind of things. I mean, it's not like you're just sitting back hurting somebody who's sitting back, on a jet somewhere. You could actually be affecting important parts of society with that kind of a game. But flashcard that would be a way to short sales, a way of mitigating market risk when you think the market is going to decline. Okay, good. Coming over and taking a look at mitigating credit risk.
Can I ask a quick question?
Uh-huh.
So the short sale seems like it's a non-value added transaction. Like there's really nothing there except for a bet. So it's not like there's anything of value there except for someone's opinion. Is that the right way to look at it?
Yeah, I mean, it's basically, traders sitting there saying, hey, I think the stock price is going to go down. And so they do a short sale.
Okay.
I'm not sure what's behind the question. Are you thinking that there's some like automatic, like some, there's theory behind it, but it's highly speculative.
Yeah, I guess I have a hard time understanding how something like that creates actual value in a market. It just seems like you said in an earlier example, it just seems like gambling. It doesn't seem like sound financial doings.
Well, I'm going to liken it to football because I like football. So you're going to have to deal with that. And we are coming up on, some big football games. So I guess it's appropriate. I look and I say the 49ers are 3-point underdogs, but I think they're going to win the game, or I think they're going to only lose by 2 points. So I make a bet on thinking something different than what the person that's offering that bet to me, right? And someone's going to win, someone's going to lose. This is the same deal. Obviously, whoever let me borrow that stock thought that the price would either stay at 100 or go up. I bet on it going down. So if the stock would have gone up to 120, I got to go buy that in a short sale deal. I got to go buy that. I lost. I'm a loser. Now, what is it based on? And go back to football, maybe I'm sitting there and I've analyzed all the plays that I think, and I've looked at all the games from the last, the whole season. And I'm like, oh no, 49ers, they're going to beat the Rams because they've got a better running game or something. You hear all these different things, right, that people talk about. So there's some analysis behind it, right? Just like I might be looking and say, well, no, their stock price is going to go down because when I look at their financial statements, they don't have enough in their allowance for doubtful accounts. And so they're going to have to put more in the allowance for doubtful accounts. That's going to create more expenses. That's going to create a loss. I don't think they're going to hit their earnings targets as a result of this. And boom, I go ahead and I, make that bet on going down. Maybe I'm right. Maybe I'm wrong. That's why I never bet on football. I never bet on football because football, there's insider information. When these casinos set the odds on a football game, they have guys who are talking to people inside the football team saying, look, so-and-so, he's gotten a fight with his girlfriend and his head is not right. He's not going to have a good game. And they feed that information to the odds makers, but they don't call the bettor and tell them that. And so it's not nearly as carefully regulated, whereas for securities and whatnot, for issuers, they have to make sure that any information is out there is available to the market overall. So they try to get all the information out there, but how I analyze that and how I look at that information could lead me to a different, prediction than somebody else, right?
Yeah. So someone managing pensions can participate in short sales. And that just seems a little, I don't know, risky to me. Doesn't seem like a good thing for pensions to be involved in. I guess that's why.
I don't know of any regulation against them doing that.
Yeah.
I'm pretty sure that they can, they can do short, they can do options, they can do a variety of investments. Now they can't invest in things like junk bonds, those kinds of things. So there is some parameters, but I don't know of a federal prohibition anyway that doesn't let a pension plan bet on, not bet, speculate on short sales. Okay. All right, good. Let's come over and where were we? Mitigating credit risk. Okay, I just want to look at mitigating credit risk here. And mitigating credit risk is managed through basically looking at someone's credit rating. Okay, and of course, you're looking at their historical performance. Mitigating default risk can be mitigated several ways. As a lender, an entity may choose to lend only to borrowers with low risk of default. And again, you could be looking at some sort of historical performance on that. Okay. All right. So with all that, let's just take a look at a couple of examples. A couple of questions here. And I think you'll see basically these are largely definitional. Let's see if the poll works today. Okay, guys, are you seeing the poll? So I have a few folks that didn't choose. So if you're not seeing it, let me know, but make your best choice here. Okay, and let's go ahead and take a look. And I'm seeing some folks are coming up with 20%. I'm not sure why we would choose that, but thanks everyone for participating. Okay. Yeah, I would have liked a little better outcome than this. I understand though why some folks would have picked A. I'm not quite seeing C. But let's just go ahead and let's take a look at this question together. And they're asking for the effective interest. And you can see why the flashcards for the definitions are important, because you have to basically take the 500,000 of proceeds, but you got to subtract what this, where they say the amount that they have to hold is 100,000. I know it's in here. Try to maintain a balance and check out the account to maintain a zero balance in the account. Company has outstanding bank loan of 500,000. Oh, it's 20%. I see where they got 100,000. So it's what, 20% compensating balance. In other words, they can't use that money. That money has to be held in the bank account. So it turns out that the net proceeds are going to actually be what? 500,000 times 0.80. I'll do it that way. They're really only getting use of the 400,000. So that's equivalent to the proceeds of the loan, which would go into the denominator here. And then for the numerator, of course, we take the 500,000 times the 0.08. So they're going to be paying what? Going to be paying 40,000 in interest. So you take the 40,000 interest, divide that by the available proceeds on this after you consider that compensating balance. And that means the interest rate is 10%, okay, which was the correct answer here. Now, I think what happened is if you chose A, you might have gone ahead and said what, 500,000 was the amount that they borrowed, okay, was available to them. If you get that, is that where the 8% comes from? Guys that chose A?
Yes.
Yeah.
I didn't understand what 20% compensating balance was. I had never
Yeah.
heard that language used.
Yeah, we didn't cover that in the discussion, but it's what's available for, for the whatever uses. And if you have a compensating balance, that's not available. I'm not seeing 20% though. Okay, that's all right. So, okay, no one needs to explain that one. Okay, question? Okay, good. Let's go ahead. I think we can take a break right now because module 6 is a little bit longer and starts to get into quite a bit of definition and whatnot. So you might want to go grab some coffee or something, and we'll come back in about, let's see. It's always a little bit funny on the break time, but let's just do 6:25 and we'll come back and start to talk about exchange rates. I don't know if somebody can remove whoever made that mark, if it'll let you remove that at this point, just so we don't have to keep seeing that mark on there. And then we'll just pick up it in about 10 minutes. I'm going to put the recording on pause, okay? And let's just go ahead and take a look here at part 2, module 6. And we're going to start getting into currency exchange rate risk. And I guess this stuff can be a little bit interesting. At the same time, it reminds me why I became, an accountant and not a, person that's involved in international business transactions. Because basically we're talking about exchange rate exists and that there are different factors that affect the relationship between domestic and foreign currencies and the volatility there. Now, again, not something that to me accountants generally have to worry about how different factors will affect different rates and how it'll cause one currency to go up versus another. We would be on the receiving end usually of that, and that's going to affect exchange rates. And then we may have to do some calculations with accounting on that. But that really hits on the financial part of the exam more than the BEC part. So I think what we're going to need to do is make some flashcards here that'll help us to remember how these different factors affect a currency and how it'll affect the currency of one country versus the currency of another. So we start to take a look here, and they tell us that there are circumstances that give rise to changes in exchange rates, and they're generally divided between trade-related factors, including differences in inflation, income, and government regulation, and financial factors, including differences in interest rate and restriction on capital movements between companies. So we're going to start to take a look at some of these and just understand how it affects the currency between two different countries. And let's go ahead and start with trade-related factors. And when domestic inflation exceeds foreign inflation, holders of domestic currency are not motivated to purchase foreign currency to maintain the purchasing power of their money. So the increase that this creates in demand for foreign currency focuses the value of the foreign currency to rise in relation to the domestic currency, thereby changing the rate of exchange between the domestic and foreign currency. Now, you look at that, and it is generally helpful to then read the examples. Okay, so let's just go ahead and take a look at the example. And we say, assume that the US dollar is relatively stable while the Mexican peso is suffering from a sudden inflationary pressure. As the Mexican peso buys less in domestic Mexican economy, Mexicans and their banking institutions seek to safe haven for the US dollar to maintain purchasing power of their liquid resources. The demand for the US dollar created by Mexicans buying them with Mexican pesos makes the US dollar more valuable in terms of the peso and drives up the exchange rate. The dollar commands more pesos in the exchange of currency. So what I think is useful, it's useful to read the definition and look at the illustration, the example, but then you could also make yourself a flashcard that indicates country experiencing inflation. Okay, in this case, in this little example, Mexico, their currency is coming down, and then it's all relative. Make the flashcard. I should have gave myself more room towards the margin. That's okay. Country experiencing inflation, their currency is going to come down. The other country, which in this example is the US, their currency is going to be coming up. And guys, I apologize for this being so sloppy, but my pen is dying here on me. I don't know why they can't make these things more durable, but anyway, country experiencing the inflation, their currency is going to come down. The other country, the US in this example, their currency would be going up. So I think that's an easier way to flashcard it so you have that relationship available there. You guys there?
Yes, I have a question. What did you write there? I couldn't read the writing. I'm so sorry. So
country experiencing, first of all, I'm writing it just to modulate how fast I'm saying it. So it's important for you to be more in dictation mode than reading mode. Okay. So you want to listen to the words more than read the words.
Sure.
And I'll repeat them.
Okay.
Country experiencing inflation, their currency is going to be coming down, is going to be deflating. The other country, their currency would be going up.
Okay, thank you.
Yeah. Yeah. It's, first of all, I don't have good writing. Secondly, these writing on these tablets is not generally good anyway. And thirdly, this pen is crapping out on me. They've got like a little rubber piece on here that is starting to die. I'm afraid to do any kind of major surgery on it because it could go from bad to worse, or it could stop working altogether. So I think we're just going to have to live with it today, and I'll have to go get another pen. But anyway, okay. Okay, good. Let's take a look now at trade factors. Again, continuing with trade factors, and let's look at income levels. Okay. So what happens as income increases in one country relative to another, exchange rates as a result of the increased demand for the current currencies in the country in which income is increasing. And so now we're looking at how income levels, and guys, I'm going to give Becker a comment on this. As a Latino, I'm not Mexican, but I'm Puerto Rican, but I get a little offended by them talking about piñatas. Like that's the only thing that the Mexican economy can create is, piñatas. And it's time for them to change this. Okay, so I apologize for their example. But I'm going to send them an email to say, hey, in the next version of the textbook, this is 2022 over here, you need to stop with these, kind of offensive examples. But anyway, but let's go ahead and take a look at this. And we say that the income level in the United States increases significantly in the second quarter. Americans flocks to Mexico City on vacation to buy piñatas. Come on. I mean, that's ridiculous. Anyway, the increased supply of American dollars seeking to buy pesos to purchase Mexican goods causes the value of the American dollar to fall in relation to the stated number of pesos. And the exchange rate is thus affected by relative income levels, which is the whole point of this example. But let's go ahead and let's flashcard. Okay, and the country with higher income, okay, what's going to happen? Country with higher income is going to see with income levels up, with higher income levels, their currency is going to be coming down. And the other country, Mexico in this case, their currency will be going up. Okay, and that's one flashcard that I'm writing it this way. Okay, country with higher income levels, currency is coming down. The other country, in this case, Mexico, their currency would be going up. Okay. Okay, good. Come over and let's take a look at government controls. And when we talk about government controls, the classic example is tariff. And again, on imported piñatas would affect various trade and exchange barriers that artificially suppress the natural forces of supply and demand, affect exchange rates. Okay. A tariff on imported piñatas would have the effect of discouraging the purchase of imports, thereby reducing demand for the peso and maintaining the exchange rate. And again, let's just go ahead and put that down as a more palatable flashcard. And so you can go ahead and flashcard that country imposing the tariff country imposing the tariff, their currency, that says currency up, their currency is going to be up. The other country whose goods the tariff is being imposed on, Mexico in this case, the other country, their currency is going to go down. People don't want their stuff. There's not going to be as much demand for their currency because there's a tariff on it. Okay. Now, there's a lot of factors that can go into this kind of a discussion. Well, what you're doing is you're making goods that people want more expensive. And, what happens is that can lead to what? Inflation, right? And I think that's part of what we're seeing now. But anyway, okay. All right, good. Let's go ahead and let's take a look at interest rates, interest rate factors. And interest rate demand for currency motivates either domestic or foreign investments. And this one, I'm just going to go straight to the flashcard, guys. I don't think we need to look at this example. In fact, this example or illustration is not very helpful. But if you have higher interest rates in another country, you may want to do what? You may want to get their currency so you can invest and get higher returns on whatever your savings are, or whatever, right? So country with higher interest rates, their currency will be going up because there's more demand for their currency to be able to take advantage of those better interest rates. And then, whatever and when I say other country, they'll generally say interest rates are increasing in, Mexico in relation to the United States. What will be the effect? And it would be and they'll give you several choices. And one of them might be that the Mexican peso is going down, or it might be that in this case, the US, in the example I'm giving, the other country, their currency would be coming down. And they'll give you a variety of factors, and we'll see some questions in a minute. They'll say, well, there'll be no effect, or interest rates don't affect exchange rates, which is nonsense. Or, that will cause the peso to go up, or that might say cause the dollar to go up. Answer is going to be that would cause the peso to go up, right? Okay.
I have a real example with that, Professor.
Huh?
So I have a real example for this one, just to put it in perspective. So I bought a condominium, for example, in Manila, and I can take a loan there to pay off.
Can I ask you to speak louder, please, just so we can hear your example?
Oh yeah. So just to put things in perspective on this scenario, I just bought a condo like 2 months ago in Manila. So if I will take a loan there, they'll charge 16% interest. So what I did is I took an equity of my mortgage here to pay off full for my loan there, because my interest rate here is just 1.25 if I'm taking equity from my mortgage. So that's what I did. So meaning that in that case, the dollar where I get the loan actually commands more value, and I save. But in that case, I save interest. Instead of paying 60%, I just paying 1.25%. So kind of that way.
Okay. Yeah, I think this example is looking at it from the standpoint of making investments in those countries, thus driving up the higher interest rates. But I'm sure it's the same ballpark as what you're talking about here. Yeah. Okay, good. Make sure you flashcard that one as well, though. What I'm trying to do here And thank you for that example, Jennifer, as I'm trying to, put it into just a quick flashcard. If this happens and this happens, because when we look at the questions, you'll kind of see that's the way they present them. Okay, good. Now let's go ahead that we understand some of these factors, but let's see now how we will mitigate. And what we're going to look now is transaction exposure. So when we talk about transaction exposure, it is defined as the potential that an organization could suffer economic loss or experience economic gain upon settlement of individual transactions as a result of changes in the exchange rate. So what happens? I buy some money from a foreign, some supplies from a foreign supplier, and I'm supposed to have to settle that for a certain amount of foreign currency, pay that in foreign currency, but I'm worried that the exchange rates are going to move during that time, and I might have to end up paying more in US dollars to settle that transaction when it comes due, say in 30 days or something. Or I have a receivable and I'm going to be receiving some money, and I'm sitting here saying, well, I'm worried that the exchange rate is going to move so that by the time I'm getting paid in US dollars, I'm actually getting paid less dollars. So we look at ways to mitigate that. We're going to be looking at some tools that allow me to mitigate that. So notice that the transaction exposure is generally measured in relation to currency variability or currency correlation. And let's just go ahead and see that they have this 2 steps here: project the foreign currency inflow and foreign currency outflow, and estimate the variability of the risk. So they give us 2 steps, but just to help us to understand what they're meaning by these 2 steps, let's just go ahead and come down, and let's look at this example and see if we can glean out the 2 steps here. So Seattle exports a U.S. import-export company. Seattle exports a U.S. import-export company. Imports commodities from Canada that it pays for in Canadian dollars, and exports commodities to Canada for which it receives Canadian dollars. If Seattle Imports anticipated that it would export 10 million Canadian to Canada over the next year, while importing 8 million over the same period, the net exposure in Canadian dollars is what? Is 2 million. Okay, and that's the inflow that's coming here. This is an inflow because it's a receivable, because we have exporting 10 and importing 8. So that is what? That is step 1. Okay, what is the net exposure, right? Then if the currency exchange rate is $75 to $1 Canadian, the net exposure in US dollars is 150. That's that 2 million times the 0.75. So I guess that's really kind of part of step 1. That's all step 1. I guess I could just bracket it off rather than write it there. I'll just bracket it off and call that step 1. And then if the rate is anticipated, to fluctuate between 5 cents between 0.75 and 0.80, the total annual dollar fluctuation exposure would be expected to be between 1.4 and 1.6. And so that just gives us a range. And so that would be estimate the variability. That would be step 2. Okay, now this particular example is just giving us the exposure. It's not telling us what we're going to do about it. Okay, so we understand the exposure, but how will we deal with these? And so let's see how we're going to deal with these and look at some tools. But let's just take a look at currency appreciation and depreciation and the effect of currency appreciation. And we can see that as domestic currency appreciates in value or becomes stronger, it becomes more expensive in terms of the foreign currency. The currency appreciates, the volume of outflows tend to decline as domestic exports become more expensive. However, the volume of the inflows tends to increase as foreign imports become less expensive. So what happens? You have the situation where revenue is going to be down, but also what? Expenses would be down, okay? Now, the effect on currency depreciation, as domestic currency depreciates in value or becomes weaker, it becomes less expensive in terms of a foreign currency. As a currency depreciates, the volume of outflows tends to rise as domestic exports become less expensive. However, the volume of inflows tends to decline as foreign imports become more expensive. So now we have a situation in which what? The revenue is going to be up and the expenses are also going to be up. When I say expenses, I really mean the cost of the goods, right? Okay. Now, flashcard down here, the economic exposure created by domestic currency appreciation or depreciation with respect to foreign currency depends on the net inflow or outflow of the currency. And that's how you would ultimately figure out what the economic exposure is that's created. Now you come over and let's take a look at translation exposure. Translation exposure really comes up because we have foreign subsidiaries. And when we have foreign subsidiaries, we're going to have to consolidate them into, say, the US parent's financial statements. And the translation exposure comes from the fact that what? There could be a change in exchange rates, and that could cause our financial reporting to make the company look more or less profitable or valuable as we translate our various assets and liabilities, revenues and expenses to the foreign currency for to the US dollar for consolidation purposes. So translation exposure is the risk that assets, liabilities, equity, or income of the consolidated organization that include foreign subsidiaries will change as a result of changes in exchange rate. Translation exposure is generally defined as the degree of foreign involvement, the location of the foreign subsidiary, and the accounting methods used and measure in relation to the effect of the organization's earning or comprehensive income. And what that's really saying to you, hey, it depends on the country, the exchange rate, okay, and also the difference between, say, IFRS and US GAAP and the way various things are accounted for. All of that is going to affect the translation exposure. And so I don't want you to flashcard that. I'm fine with this highlighting it, but I don't want you to flashcard that. I want you to flashcard the elements here. So degree of foreign involvement, translation exposure increases as the portion of foreign involvement by subsidiaries increases, right? More countries involved, a larger volume of activity involvement with that foreign subsidiary, that's going to obviously increase the translation exposure, okay? Taking a look at location of the foreign investments, and let's just take a look at that. The more stable the exchange rate, the lower the translation risk, the more volatile the exchange rate, the higher the transaction risk. So if you're in a more stable, you're dealing with a more stable currency, obviously that's going to be less exposure. Okay. Now, what we really look at here, even though we talk about the translation risk, you might look for involvement with foreign subsidiaries with maybe more stable currency and whatnot. But really, what we try to do is mitigate the transaction exposure. Again, I have bought something from a foreign supplier, And now I'm going to have to look and, settle that up in a different currency. And I'm worried that exchange rates are going to move against me. How am I going to protect myself against that? Okay. And so you take a look and they tell us here that the use of financial instruments in hedging attempts to mitigate the effect of exchange rate fluctuation on individual transactions. And the following is going to basically look at how we can use some of these tools, if you will, to mitigate some of these factors. So when we do this, measuring specific net transaction exposure is the amount of gain or loss that might result from either a favorable or unfavorable settlement of a transaction. And again, when we look at the tools, we're trying to mitigate losses. If we have a gain, that's fine. I mean, we're not going to try to mitigate gains, obviously. We're more interested in the dealing with the losses. So let's just look at selective hedging. And hedging is a financial risk management technique in which an organization seeks to mitigate the risk of fluctuation in value, acquires a financial instrument that behaves in the opposite manner from the hedged item. Okay, so let's just go ahead, flashcard that definition of what a hedge means, but let's just take a look at the example and see how that would work. So we have this worldwide sweet peaches by shipping crates for its product from Mexico. The company incurs liabilities denominated in pesos that it satisfies in pesos bought with US dollars at the time of the settlement. The company incurs a significant liability in pesos at a spot rate of 10 cents. Worldwide management expects the peso will strengthen to 20 cents by the time the bill is due and thereby double its cost. And you're like, well, what's the big deal? 10 cents. But of course, we'd multiply that by the number of units here that we're dealing with. To mitigate this perceived transaction risk, the company decides to hedge its position by locking in the current peso spot rate for 10 cents. Now, spot rate is the rate at the time of the transaction, okay? And the settlement rate is what it's going to be, say, 30 days from now or something, when we have to ultimately pay this. And so what they can do is use some of these instruments that we're going to be talking about to sit there and basically lock in that peso at 10 cents so that we don't, double the cost of whatever we're doing later on. You're going to see some of those tools. I'm just going to go ahead because they're going to give us some steps to identify net exposure, which again is another definitional thing. But when we get down here, we're going to really start to see some of the tools that we can use to lock in that interest rate at not interest rate, but that settlement rate at 10%, which is the current spot rate. But let's just take a look at identifying net transaction exposure. And net transaction exposure considers the effect of transaction exposure on the entity taken as a whole, rather than on individual subsidiaries. Although exchange rate issues might adversely affect one subsidiary, they might favorable another. The net transaction exposure is the aggregate exposure for a particular foreign currency for a particular time and computed as follows. And we've seen how we will accumulate the inflows and outflows of foreign currencies by subsidiary, consolidate the effects of the subsidiary by current type, and compute the net effect in total, and then work to mitigate some of those risks accordingly. But just flashcard the steps here for calculating the net transaction exposure. And then let's just go ahead and start to look at some of the tools, starting with future hedges. Okay, so let's just go ahead and take a look at future hedge. And a future hedge entitles its holder to either purchase or sell a particular number of currency unit for identified currency for a negotiated price at a stated date. Future hedges are denominated in standard amounts and tend to be used for smaller transactions. Okay, so more current, common, smaller transactions, we're going to use future hedges. So flashcard that. And we're going to look at the accounts payable application here. And then we're going to take a look at accounts receivable application, because again, either would, expose us to transaction exposure. So let's just take a look. And future hedge contract to buy currency at a specific price at the time the account payable is due will mitigate risk of a weakening domestic currency. And let's just go ahead and take a look at this example. Worldwide Sweet Peaches buys crates from Mexico. Again, it's that same example, but now they're going to be showing us ways to, sorry, get my center this up a little bit better. I don't know if I'm off center or my camera's off center, but I feel like I'm spilling off the edge here. So let's just fix that up a little bit. Okay. So it's the same example, but now we're looking at how we're going to use, in this example, futures contract to mitigate some of that risk. So on the date that Worldwide Sweet Peaches buys crates and incurs a significant liability in pesos, the spot rate is 10 cents because the company fears the peso will strengthen to 20 cents by the time the bill is due. The company enters into a future contract that will allow it to purchase the pesos needed to pay the liability for 10 pesos in 30 days. So they're going to have a future contract that locks in that 10. So again, the takeaway here is how do we mitigate the transaction exposure for an account payable? We could use a futures contract for that. Okay. Now, another way to look at this is from the standpoint of an accounts receivable. Okay. Now we're in a situation where we're going to be receiving money, and we're going to use a futures hedge here, okay, a futures hedge to sell foreign currency received in satisfaction of the receivable at a specific price. Okay, so we have what? We have payables exposure, we have receivable exposure. We can use future hedges as tools for both of those. So let's look now at this Running Apparel International US-based retailer had international retail operations in several countries, including significant business in Japan. Company management expects that the Japanese retail operation will generate and liquidate a significant amount of its accounts receivable in 30 days. Although the current dollar to yen spot rate is $1 for 0.9802 yen, company management expects that the dollar spot rate will be $1 for 1.209 yen in 30 days. In other words, they're not going to receive as much dollars. So to mitigate this expected foreign exchange loss caused by appreciation, the dollar relative to the yen, the company enters into a future contract to sell yen at the current spot rate. So regardless of how much they end up getting paid to them in yen being less dollars later, they know that they can lock in at those higher rates using the futures contract. Okay, so important, not important, but the big picture here is you have what? You have transaction exposure. Future hedge contracts can be used to help you both for payable exposure and a receivable exposure. Okay, all right, good. Let's take a look at how to use a forwards hedge. So we use future. Let's look at forward hedges. Okay, and a forward hedge is similar to future that entitles the holder to either purchase or sell currency at an identified currency for negotiated price in the future point. Although future hedges tend to be used for smaller transactions, forward hedge contracts between business and commercial banks are normally for larger transactions. And so that's what I want you to flashcard here, that if you have a larger transaction, you would use a forward hedge, and just go ahead and flashcard that. Okay, again, all of these are, really kind of definitional as to tools that you can use to mitigate transaction exposure. And again, you can use it in an accounts payable application, accounts receivable application. Okay, so we've got what? We've got futures, we got forwards, futures for smaller transactions, forwards for larger transactions, and they can be, used for accounts payable, accounts receivable application. Okay. Now another tool, and again, that's where we are. We're looking at tools to mitigate some of this transaction risk. Another tool would be to use a money market hedge. Now, a money market hedge uses domestic currency to purchase foreign currency at spot rates, invest them in securities timed to mature at the time the related payable comes due. And so you can go ahead and flashcard that. And let's go ahead and see what happens when we have a payable. And let's see what happens if we have excess cash. Okay. Firms with excess cash use money market hedges to lock in the exchange rate associated with the foreign currency needed to satisfy the payable when they come due. Money market hedges for payable satisfaction follows the following steps. Okay. And let's go ahead and flashcard those steps. Okay. So what are you going to do? You will determine the amount of the payable, determine the amount of interest that can be earned to settle the payable, discount the amount to the payable to the net investment required, and purchase the amount of foreign currency needed, deposit it, earn the interest. You have the money available to settle that at the time that it comes due. So let's just look at that. You're going to see actually that the money market hedges to me are, these examples are kind of a little bit funner than the other examples we had, because they actually use some numbers in these. And again, pinatas, it's irritating, has a payable due to Mexican suppliers in the amount of 100,000 pesos in 90 days. The current exchange rate is 8 cents per peso, and Mexican interest rates are 16%. Duffy has 100,000 excess cash and elects to use a money market hedge to mitigate, and performs the following steps, which we've already flashcarded those steps. Now, notice they're using 4% as the interest rate here, and I just want to make sure we're clear on that. If it's 16% annually, that says annual. Boy, this pen is just shocked. 16% annual, and just go ahead and put annual on there. Okay, and we have what? We divide that by 4 quarters. And the reason we're dividing that by 4 quarters is that it's what? 90 days. So they're breaking the year into 4 quarters, 4 90-day quarters. That's what? A 4% quarterly rate. Okay, just showing you where that 1.04 comes from. Now, you know, I like to set up, when they just kind of show you these, for me, I like to set the algebra up. So what happens? I have $1 million that I'm going to have, or 1 million pesos that I'm going to have to pay, not dollars, but pesos. And that is going to be equal to what? 1.04 times the present value of the pesos, right? Because I want to see how much peso do I have to invest now with a quarterly growth rate of 4% to end up with 1 million pesos at the end of the 90 days. Then I go ahead and I do the algebra, okay, just to understand the logic of this setup. And this tells me that I have to come up with 961,538 pesos today in order to have 1 million pesos 90 days from now at a 4% rate quarterly. Okay, so what happens? I go and I purchase the pesos, and I need $76,923. I have excess cash because the exchange rate is what? 8 cents per peso. if I need 961,538 pesos to invest to grow to the million, then I have to cough up $76,923. And then I go ahead, I invest the pesos, and then I have the 100,000 pesos. And so they have secured its current 80,000 payable for 76,923. They would go ahead and of course do that since it's costing them less to make sure to ensure that they get that 80,000. Okay. Okay, good. Let's take a look at borrowed funds. Now with the borrowed funds, I'm going to have to borrow some money to be able to purchase the pesos that I need to then have them grow to whatever it is that I need to pay off at the time of the settlement. So firms that do not have excess cash follow the same basic procedure, except now they have to first borrow the funds in order to be able to invest them and have them grow to the desired amount of pesos. So let's just go ahead and take a look, and you can see it's very similar. Duffy discounts piñatas as a payable due to the suppliers in the amount of 100,000 pesos. By the way, the $80,000 was, they didn't explicitly say that in the question, is the million times the 0.08, right? Times the 8 cents, okay? And then the current exchange rate is 0.08, thank you. Mexican interest rates are 16% and US interest rates are 6%. Duffy computes it must borrow 76,923 to use a money market hedge to mitigate the transaction exposure. That came from the previous question, guys. That's how we came up with that 76,923 to exchange rate risk consistent with the first money market hedge example, but has no excess cash. Okay, so Duffy borrows the needed amount for 90 days in the United States. So what happens? We're going to now look at this and say, well, look, I'm going to have to borrow 76,923. Okay, 76,923. But I'm going to have to pay interest on that of what? 6% for 90 days. And on the CPA exam, when you're calculating interest like that, just use a 360-day year because they're assuming that every month has every month has 30 days in it, all 12 months. So we kind of assume a 360-day year. And so when you do the math on that, guys, that's how they come up with this interest here that you're going to have to pay, which is 153, not 1153, 1153.84. Okay. And since you're going to have to pay that interest on that, then you're going to have to add that to the 76,923. So if you take the 76,923 plus the 1153, which we just calculated, that means that it's going to cost you what? 78,077. So the only difference was we had to what? We had to figure out the interest on the borrowing because we didn't have the excess funds. Whereas we had excess funds, we would just would have cost us 76, but we had to add the interest here. Okay. All right, good. Let's take a look at currency option hedges. So now what we're going to do, and again, we're still in the mode of tools that will help to mitigate these transaction exposures. So just to make sure that we're, staying on target of what we're talking about here. And now we've talked about using forward contracts, future contracts for smaller transactions, forward contracts for larger transactions. We've talked about money market hedges, but now let's go ahead and talk about option hedges. Okay, and let's see, the currency option hedge. Where's my currency option hedges? Right here. The currency option hedges gives the business the option of executing the option contract or purely settling the originally negotiated transaction without benefit of the hedge, depending on which is more favorable. So, you know, the option's a little different. With the money market, we had to actually go into the market and actually acquire the currency. Here, we're going to pay an amount for the option to acquire the currency at a certain rate. And if the market moves in the opposite direction, then we just don't exercise the option. Okay, if it stays the same, we don't exercise the option. But if it moves the way we think it's going to, then we're going to exercise the option. Okay, so for payables, okay, we would use a call option. A call option is an option to buy the currency. So go ahead and flashcard that. A call option is the option to buy the security. I'm calling it. I'm just calling you and saying, hey, I want to buy this currency, right? So that's a call option, and that would be useful for payables here. And we say that it is similar to a future or forward contract. The business plans to buy a foreign currency at a low rate in anticipation of the foreign currency strengthening in comparison to the domestic currency. And so you come over and let's flashcard here what we should do if the option price is less than the exchange rate at the time of the settlement. The business will exercise its option. If the option price is more than exchange rate at the time of settlement, the business will simply allow the option to expire. And, you know, companies prefer this option approach because they don't have to actually buy the currency. They just have that option, and they either exercise the option or they let it expire depending on how things move. Although the option premiums are used to compute any net savings, they are sunk costs and irrelevant to the decision to exercise the option. So you don't consider that in your decision to exercise the option. It is part of the net savings, but you don't consider that when you're deciding to exercise the option. Okay. Now some definitions, but let's look at this example. And again, guys, I think you can see that this part of chapter 2 is heavily dependent on looking at the examples. So remember, in the how to study file, I tell you make the flashcards, but study the examples because that helps you to you know, get to understanding what we're saying in the flashcards. So let's take a look, and they tell us that Garrity International owes a Mexican supplier $1 million pesos due in 30 days. Although the peso is currently exchanged to US dollar for 8 cents, the company is fearful that the Mexican peso will strengthen in comparison to the dollar before the settlement to as much as 10 cents. Garrity International pays 0.005 option premium to secure an option to buy the $1 million pesos for 8 cents. Okay, and compute Garrity's net savings, assuming that Garrity is correct, and the assessment of the international exchange rate at the time of the settlement increases as predicted. Okay, so the settlement rate is spot settlement rate is 10 cents. Okay, so it moved the way they thought. The option price was 8 cents, but we had to pay a premium of what? We had to pay the premium of the 0.005 cents. So really, the total option is 85 cents. But notice what we were able to protect ourselves by only having a net cost of 85,000 as opposed to $100,000 if it had moved to 10 cents. And so our savings was 15. Okay, and let's just look at the discussion here. Gary's consideration for the option is 5,000 and is paid regardless of whether the option is exercised. The gross savings of 20,000, which would be the difference between the 10 and the 8 times the million pesos, is reduced by the $5,000 option to reflect a 15,000 net savings. Now, if they're wrong, and let's say things stay at 8 cents, then what? Well, at that point, they just simply let the option expire. They don't worry about, well, wait a minute, I paid 5,000 for that, so I have to consider that. So now the savings, what if I let the option expire, is going to, or not the savings, but the cost of that is going to be 5,000, because I did pay that 5,000 out, so that's part of my cost, but it is not part of the discussion as to whether or not I would exercise that option. I let it expire because there's no sense in having to exercise that option, because it's not going to save me anything, because I would sit here and you know, be able to settle it for 80,000. So just let the option expire. Okay, we come over and let's take a look at, well, I'm not going to look at the example, but I do want you to realize that you could also use option hedges for receivables. So you can use them for payables. You could use them for receivables. Okay. Now you come over and let's just take a look, and it's just moving the opposite direction. Now it's money that you're going to receive that you're hedging a change against through the option. Again, mitigating transactions for long-term exposure. We can use long-term forward contracts for that. Deal with the same issues as forward contracts, but they are, you know, more geared for a longer term. We could also have currency swaps, okay, and we can use currency swaps dealing with two firms, financial intermediaries, and something called parallel loans. So just understand that those are definitions of currency swaps. Okay, so what I want to do at this point is go ahead and let's just take a look at some questions. And I think what you're going to see is there's definitions in here, and largely the definitions are dealing with, well, what happens as one currency moves one way, another currency moves the other way, and then what are some tools that we can use to mitigate some of that transaction risk is going to be the other thing we're going to look at. So let's just take a look at this first one. And I'm going to relaunch the poll and see what happens with the first question. Okay, good. Looks like we've had a chance to go through that one. So let's go ahead and I'm going to end the poll. And okay, pretty good. I think that most of us got this right pretty quickly. I mean, I was right about on 2 minutes, so that's good. And this is a pretty straightforward question. The answer here is A, but let's just take a look. Let's maybe start from the bottom, or not. Let's just look at the question. If the dollar price of the euro rises, which of the following is will occur? And you kind of look at choice B and you're like, well, no, that can't be right. The euro doesn't depreciate. If the euro rises, the euro is what? Appreciating. So that's sort of opposite. And you kind of look at A and you say, well, that sounds right. The dollar price of the euro rises. That means the dollar is what? Is going down against the euro, right? It's costing me more dollars to get the euros. And if it's costing me more dollars to get the euros, maybe I should have started with C. The exchange rate is not between the euro and European goods. It's not going to, that's almost a nonsense answer. And then D, the euro will buy fewer US goods. No, the euro will do what? Buy more US goods, because it's going to what? You're going to be able to acquire more euros with the more dollars with the euro. And so you will probably buy more US goods. So, you're probably torn between, person might be torn between A and D there. But when you think through it, well, what does the, what did having euros allow me to do? It allows me to buy US goods, and I can't get as many euros. I can't get as many dollars now with as many dollars. I can't get as many euros with those dollars, so the euro will buy fewer US goods. Okay. All right, good. Let's take a look at question 2. Okay, good. Let's go ahead and take a look at this one. And most of us got it right. Okay, a little tougher than the first question, but oops, sorry, I forgot to share the results. Sorry, but most of us got it right. 63% of us. I'm going to just end the poll here because I don't want that up there while I'm talking. But most of us got that one right. And what is the effect when the foreign competitor's currency becomes weaker compared with the US dollar? And let's just take a look. The foreign company, obviously A and B are opposites. The foreign company will be at an advantage in the US market because it's going to do what? It's going to require more foreign currency to purchase the dollar. And so they're going to be at an advantage in the US market because now the dollar will buy more of the foreign currency, and so the foreign items will become cheaper in the US market. So A and B are mutually exclusive. The fluctuation in the foreign currency exchange rate has no effect. That's obviously nonsense, okay? And then it is better for the US company when the value of the US dollar strengthens. No, it's not, because now what? Now our exports are going to be more expensive because it's going to require more of the foreign currency to acquire the dollars needed to pay for that. So it's not to an advantage because their exports are going to be more expensive. So the foreign company will have the advantage in the US market. Okay. All right, good. Let's take a look at the next one. Okay, guys, I think most of us had a chance to select our best choice. So let's look at this. And good. Looks like we did pretty good on this one. We're at 84%, which is great. But let's just go ahead and look at this one together. And the answer here is C. But you start to look at some of these and it's like, well, look, we know that we can reduce this is basically dealing with transaction risk that we've been talking about. We know there are different tools for that, right? Now, one of the tools was not buying the euros now. I mean, that's not getting you anywhere. If there's a fluctuation, you have 30,000 euros, buying them now, I don't see how that's going to help you at all. I mean, that again is another nonsense answer. And so what? What would you do? You're receiving those. So buying them now is not going to help you at all. And then enter into interest rate swap. Well, that would be a tool that would help me to some sort of interest rate fluctuation exposure, not currency exposure. So that's not right. So it's almost, I think, proven by, how many of you got that right. And your only option here is choice C. Buy the enter into forward contract to sell 30,000 euros at whatever the spot rate is, or the current rate is, the spot rate is now, and you protect yourself against any fluctuations. Okay, good, guys. Take a look at the homework now for these last couple of modules that we've done. That's really what you need to be doing before we reconvene next week. We're still on track. I don't want to start chapter 2 tonight, even though we have a little time left. And so we will go ahead and pick up chapter 2 and work our way through those modules next time. Make sure that you are registering for the exam. Make sure that you are filling out that exam planning questionnaire. That's going to be due, what is it, the 29th, that's due?
I think it's the 28th.
28th, okay, just watch the due date on that, but it is coming up on you here the end of the week, so make sure you're turning that in. If you do have questions, I know some of you had come in to my office hour and I had to miss that. So if you do have a couple of one-off questions that I can help you with, let me know. We can do that now if you want to, once we have adjourned the class. Don't worry about getting it perfect. You can turn it in and then I'll take a look and I'll give you any comments on that. But do make sure you're turning that in and make sure that you're, following the steps to register for the exam. Okay, and finish up those last few modules for chapter 1. Okay, guys, anything else?
Thank you.
Okay, thanks, guys. I'm going to go ahead and stop the recording.
Thank you.
Thanks.
All right, we'll